The good news for income investors is that we now have decent cash rates again, which, that really is the rising tide that's lifted all income boats. And so with cash rates now, at 4.1%, that provides a nice baseline to income generation in the portfolio. And then that also means that your fixed income assets are generating healthy yields again. The important point there is that fixed income assets are more defensive in nature. And so the good news with those is we're expecting higher and more consistent income from that proportion of the portfolio. And then when you look at the equity side of the portfolio, as earnings start to return back to a growth trend line, of course, just as a function of payout ratios, dividends should then also start to grow. So, we're ultimately expecting broadly higher levels of income across portfolios, but equally that those levels of income are going to come from more parts of the portfolio, and so should be more stable. Traditionally, we use that as a defensive asset class. Now, because of quantitative easing and low interest rates, most investors were pushed out the risk curve and reduced their exposure to bonds, quite simply because there wasn't much return left in them. Now, as interest rates have come up, that's lifted the rate of returns on bonds broadly, which includes, of course, government bonds and credit. Now, we had been leaning into credit because it had a higher yield, and we felt comfortable that the default rates weren't going to significantly increase and impair that yield. However, now with interest rates as they are, we feel comfortable that government bonds provide a sufficient enough return for that part of the portfolio, and they provide far more of the defensive characteristics that we're hoping for from that part of the portfolio. We now have a tilt of 40% to Australian fixed income and 60% to global. And there's a good reason for that split. It wasn't just a number we plucked out of the air. So when we think about the overweight or the higher weighting to international fixed income, the primary driver of that is the simple facts that globally you've got better sector diversification from a business point of view. You think in Australia, large proportion of our sectoral weighting is coming from banks or mining. Globally, it is more better spread, so you're getting better diversification. And equally, global capital markets are far deeper and therefore stronger than our local market. So it makes sense to have a bit of a higher weighting into the international space than we do locally. But of course, we do also exhibit a bit of a domestic bias. We allocate more to local fixed income than broad issuance metrics would suggest. However, when we think that the vast majority of our investors and stakeholders are Australian dollar-based investors, and therefore are at the whim or at the mercy of Australian dollar inflation and Australian dollar economic dynamics, it also makes sense to have a meaningful exposure to Australian fixed income.